When people talk about investing, what they usually mean is active investing. Active investors try to beat the market by predicting the future and picking the right investments at the right time. But that's not proper investing. It's more akin to speculation or gambling. Passive investing, buying and holding globally diversified portfolios of passively managed funds, makes much more sense. The problem is, old habits die hard. Investors have speculated for centuries. In the 1630s, tulip bulbs sold for eye-watering sums until suddenly prices crashed. A famous book called The Great Mirror of Folly was published in 1720 in the wake of the first major international financial crisis, which was triggered by the South Sea and Mississippi bubbles. It served as a cautionary tale about the dangers of speculation and greed. But we still haven't learned the lessons. There will always be speculative frenzies. So what should investors do? In his book, Index Funds, a 12-step recovery program for active investors, Mark Hebner provides a possible solution, inspired by Homer's epic poem, The Odyssey. In the poem, the hero Ulysses devised a plan to avoid the distraction of the sirens during his journey home from the Trojan War. The sirens were mythical creatures known for their enchanting voices and music, which lured sailors to their doom. Knowing the danger posed by the siren song, Ulysses ordered his men to plug their ears with beeswax so they wouldn't hear the song. But Ulysses, curious to hear the siren song himself without succumbing to its spell, had his men tie him to the mast of the ship. He instructed them not to release him, no matter how much he pleaded. As the ship sailed past the island of the Sirens, Ulysses was enchanted by their song and, true to his prediction, begged his men to release him. But they observed his original orders and kept on rowing until the sirens were out of earshot and danger had passed. Investors too face siren songs, whether it's fund industry, advertising, or the financial media urging them to buy this or sell that. So what you need is your very own Ulysses Pact in the form of an investment policy statement, an agreement made between you and your financial advisor. It entails agreeing up front that you won't engage in active speculation or act on emotions that can lead to irrational and wealth-destroying decisions. It could mean the difference between achieving your financial goals and not. Traditionally, the second step in a 12-step program is to acknowledge a higher power. Investors have their own higher power, empirical evidence. A huge amount of academic brain power has been applied to the question of how to invest, and yet many investors just aren't aware of it. This makes them highly susceptible to the lure of active investing and slick financial salespeople, so they engage in risks they do not understand and cannot quantify. One of the founding principles of evidence-based investing is the wisdom of the crowd, which was developed by the English mathematician and polymath Sir Francis Galton. Simply put, Galton demonstrated how a large group of people can collectively make more accurate judgments than individuals, including experts. Every day, millions of investors around the world place millions of trades. With each trade, they're effectively expressing an opinion as to how much an asset is worth. So the market is like a giant supercomputer and therefore very hard to beat. Another key principle is that in the short term, movements in stock prices are completely random. In his book, A Random Walk Down Wall Street, Princeton economist Burton Malkiel explained why investors should abandon stock picking altogether. He wrote, "A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by the experts." In fact, evidence-based investing draws on the work of several winners of the Nobel Prize in Economic Sciences. They include Harry Markowitz, who showed how broad diversification reduces risk and improves long-term returns; William Sharpe, who helped explain risk and volatility; and Eugene Farmer, who deepened our understanding of market efficiency and the different types of risk that drive returns. Armed with those lessons, you can better fund your own lifestyle and retirement, and not your brokers. Beating the stock market by identifying in advance which stocks will outperform is extremely difficult. Think about it logically. The market is like a vast processing machine, a collective brain that compiles all knowable information. Is it realistic to presume that one person can know more than the combined knowledge of 10 million traders? Here's another way to look at it. All knowable information is already reflected in market prices. It is, if you like, baked in the cake. No one has special knowledge that is not already included in the price, except for inside information, and trading on that is illegal. What causes stock prices to move? News events and new information. By definition, news is almost impossible to forecast. Now you might be thinking, okay, I don't know which stocks to pick, but why not look for a talented, active fund manager who does? But it's not that simple. In the long run, the vast majority of actively managed funds underperform the market on a properly cost and risk adjusted basis. Remember, there are thousands of active funds to choose from. At any one time, there's bound to be a manager who looks like a genius by chance alone. In fact, actively managed funds ought to come with an official wealth warning. Although they occasionally strike lucky, virtually all managers lack genuine stock picking ability. Of course, the media loves a good story, so when a manager finds random success, they're adorned with guru status. When their fleeting success fades, their guru title is handed to the next lucky stock picker. Unfortunately, luck is not a repeatable skill. Vanguard Group founder Jack Bogle compared the practice of stock picking to looking for a needle in a haystack. Investors, he said, are better off simply buying the whole haystack. In short, stock picking is an ill-fated strategy that wastes time, energy, and money. A much better solution is to avoid it altogether and trust that collective brain. There are basically two ways to outperform the market. We looked at the first, stock picking, in step 3 and explained just how hard that is. The second way to do it is through market timing, and the bad news is that's even harder. In a study entitled Likely Gains from Market Timing, Nobel Laureate William Sharpe set out to identify just how often a market timer would need to be accurate to outperform. His conclusion? They would have to be right 74% of the time in order to beat a passive portfolio at a comparable level of risk. Now, to the uninitiated, getting out just before prices fall and back in again as they're about to rise might seem like a reasonable challenge to take on. But prices are constantly twisting and turning with no predictable pattern, and recent price movements tell us nothing. Of course, the goddess Fortuna or Lady Luck might just be smiling on you, but the chances are you'll make the wrong call far more often than the right one. The key point is, current market prices reflect all knowable information. It's new information that causes them to move, and it happens very quickly. In his book, Analysis for Financial Management, Robert C. Higgins wrote, "The arrival of new information to a competitive market can be likened to the arrival of a lamb chop to a school of flesh-eating piranha. The instant the lamb chop hits the water, there is turmoil as the piranhas devour the meat. Very soon, the meat is gone. No amount of gnawing on the bone will yield any more meat, and no further study of old information will yield any more valuable intelligence." Remember, markets are fiercely competitive. The chances that you know more than the combined wisdom of everyone else are very slim. So accept current prices as fair prices and don't try to second guess future market movements. The best strategy is simply to stay invested. Most investors are familiar with the disclaimer, past performance is no guarantee of future results. Regulators insist on it for a reason. Fund performance is extremely unpredictable. This chart shows the results of a study using Morningstar data of active fund performance over a 15-year period from the start of 2007. On average, only about 7 funds remained in the top 100 funds the following year. That's right, of the top performing funds in any one year, only around 7% were still in the same bracket 12 months later. Fund managers love to outdo each other and become Manager of the Year, but for investors, it's almost completely irrelevant. Investing is a marathon spanning decades, not a 12-month sprint. S&P Dow Jones Indices produces a regular scorecard on the persistence of outperformance by active managers, and the results are eye-opening. This chart shows that over the 3-year period from September the 30th, 2013, just 354 out of 2,318 funds outperformed their respective benchmarks. Of those, just 4, yes, 4 outperformed in the subsequent 3-year period as well. The active fund industry is understandably keen not to draw attention to this chronic lack of consistency. It prefers to present more flattering data, which disregards those many funds whose performance was so bad that they were either closed down or merged with other funds. This is a classic example of what statisticians call survivorship bias, and it's highly misleading. Despite the elusiveness of consistent outperformance, investors still chase after it, even large institutions and pension plans. One study found that the hiring and firing of managers by consultants, board members and trustees was a waste of time and money. The researchers also noticed a tendency to hire managers with a history of good returns and fire managers with poor returns. But after managers were hired, their excess returns were indistinguishable from zero, and the managers that were fired performed better than the hired managers. In short, the idea of fund managers consistently outperforming is a myth. It's no more believable than unicorns, Bigfoot, or the Loch Ness Monster. So focus on the evidence instead. When you buy a box of cornflakes, you expect to see cornflakes in your cereal bowl, not granola or raisin bran with a few cornflakes mixed in. Consumers rightly expect products to be correctly labelled. But the contents of actively managed mutual funds often vary, sometimes significantly, from their labels or stated benchmarks. This phenomenon is known as style drift. For example, you may have intentionally invested in a growth fund, but unbeknown to you, your active manager has invested 30% of the fund's assets in cash and bonds. Or you may buy a bond fund only to discover, perhaps after a fall in the stock market, that the manager had moved 30% of the assets into equities. That's a big deal. Shifts like those can change the risk exposure, the expected return, and the time horizon of your investment. The primary objective of active fund managers is to outperform their fund's stated style benchmark. When active managers assume their stated style will underperform their benchmark, they may lean away from or even abandon their stated strategies to chase the returns of other investment styles. The problem is, deciding which style to lean towards is far from straightforward. This chart, the Callan Periodic Table of Investment Returns, shows the annual returns for 8 asset classes for each calendar year from 2004 through 2023, with the best performers at the top and the worst at the bottom. The asset classes are colour-coded, and as you can see, high and low returns of key market indexes are completely random, following no discernible pattern. That is what is expected in an efficient market. One of the benefits of index funds is their style purity. For example, if you buy a US small cap index fund, it will contain nothing but US small cap stocks. In short, you know exactly what you're buying with index funds. Style pure investments with the appropriate level of risk and no surprises. One of the biggest problems with active money management is that it's very expensive. And it's not just fund managers you pay. You could be paying fees and charges to all sorts of people. For example, stockbrokers, investment advisors, accountants, market makers, transfer agents, mutual fund distributors, and income tax agencies. They're rather like silent partners, not necessarily doing very much, but all happily taking a share of your investment returns. Sadly, that's how the investing industry works. You take all the risk and you provide all of the capital, but everybody wants a slice of the pie. So, how much of your returns are you losing to fees and charges? Well, based on data reviewed by IFA for the 15-year period ending December 31st, 2021, investors in taxable accounts would have kept only 65% of the growth of $10,000 of an average active equity fund compared to 95% of the growth they would have earned in an S&P 500 index fund. Active investors also pay more tax. This chart shows the tax implications of investing in the average active equity fund compared to an S&P 500 index fund for the 15-year period ending June the 30th, 2022. After tax, $10,000 invested in the active fund would have grown to $16,658. The same amount invested in the index fund would have grown to $30,450. Also bear in mind that the higher the fund's turnover, in other words, the more your fund manager trades, the more you incur in tax and other costs. Passive funds keep trading to a minimum, but many active funds have a very high turnover. Last but not least are fund management fees. This chart shows the difference in expense ratios between the average actively managed fund and a 60% stock, 40% bond index portfolio. As you can see, the active fund is more than 3 times as costly as the blend of indexes. Of course, all investing incurs costs, but by keeping those costs and those silent partners to a minimum, you can end up with significantly higher investment returns. Every investor needs a basic understanding of risk-ease. That's Mark Hebner's name for the language of risk. Here's a crash course. One way to think of risk is as uncertainty. It's the chance that an investment's actual return will differ from the expected return. How then can you quantify that risk? Well, it's the degree to which the returns of the investment differ from the average return of that investment during specific periods of time. That deviation can be best described as the standard deviation. This bell-shaped curve represents a set of outcomes, let's say the monthly returns of an investment. The yellow area covers plus or minus 1 standard deviation from the average in both directions, and it accounts for approximately 68% of the outcomes. The yellow and green areas cover plus or minus 2 standard deviations from the average, and they account for approximately 95% of the outcomes. So, the higher an investment's standard deviation, the greater the chance that future returns will lie further away from the average return. There are basically 2 types of risk: systematic and unsystematic risk. The entire market is exposed to unavoidable systematic risk, such as war, recession, inflation, and government intervention. In contrast, unsystematic risk refers to threats specific to individual companies, such as lawsuits, fraud, and competition. Returns are essentially a reward for taking risks, but not all types of risk are equally rewarded. Market risk is the risk of buying stocks. Historically, stocks have significantly outperformed cash and government bonds. But there are certain types of stocks that, over long periods, have delivered higher returns, principally small stocks and value stocks. As for bonds, well, those with longer terms and lower credit ratings have higher expected returns. These are complex matters, and we urge you to read more about them in the book. But although you need to understand risk, you shouldn't be frightened of it. Taking the right amount of risk and the right kinds of risk will help you achieve your financial goals. Short-term movements in the financial markets are essentially random. They tell us little or nothing about future returns. But there is value in looking at returns over very long periods of time. History doesn't tell us exactly how different assets will perform in the future, but studying long-term data helps us to understand the risks involved in investing in those assets and the returns they've delivered over many decades, empowering us to make better choices. Another benefit of studying financial market history is that it reminds us just how resilient capitalism or human enterprise actually is. Look at all these events that have occurred over the past century. The crash of 1929 was a devastating blow to the US economy. But there was far worse to come, a long depression and then the Second World War. Then came the Cold War, the Korean War, and the Vietnam War. That was followed by the rise of global terrorism, the COVID pandemic, and renewed tensions with Russia over the war in Ukraine. All of these had major short-term impacts on market prices, and yet, in the long term, the market marched ahead. In his book, Mark Hebner refers to the dimensions of returns, or the types of stocks that have delivered the highest returns over time. As this chart shows, between 1928 and 2021, US stocks generally outperformed Treasury bills. Value stocks beat growth stocks, small stocks outperformed large stocks, and high profitability stocks outperformed low profitability stocks. This outperformance didn't occur over every single time period, but the reassuring thing is that the longer the period, the more likely the investor was to benefit from all of those different risk premiums. Again, there's no guarantee of outperformance in the future, but investors can and should take real comfort from long-term market data and the resilience of capitalism over time. Equity investing can be very hard. A useful analogy for the stock market that Mark Hebner uses in his book is that of a wild bull. Investors are like bull riders trying to hang on as the bull kicks and twists, rears and spins. Matching the right portfolio to an individual's ability to handle risk is like finding the right bull for each investor to ride through all the ups and downs of the market. Each investor has a unique risk capacity. Your risk capacity score is a measure of how much risk you personally can manage. Your score is based on 5 specific dimensions of risk capacity: your time horizon, your attitude towards risk, the investments you already have, the income you earn, and the level of your investment knowledge. The aim is to take as much risk as you need to, as you can afford to, and as you feel comfortable with, but no more. Get it wrong, and you could come badly unstuck. The best way to determine your risk capacity is to engage a financial advisor who will ask you to complete a risk capacity survey. Based on your risk capacity score, the advisor can then build you a portfolio that's right for you. One more thing, make sure you're fully engaged with this process. It's really important and requires careful thought and self-examination. Having the right risk capacity score and portfolio to match are crucial components of your long-term investment success. Once an investor has identified their risk capacity, the next step is to match it to the right asset allocation or risk exposure. Asset allocation is the most important determinant of a portfolio's expected return, so getting it right is crucial. Academics Eugene Farmer and Kenneth French showed that as much as 96% of equity returns are explained by exposure to the market, size, and value factors. Indexes constructed of US small and US value stocks, Farmer and French demonstrated, have historically outperformed the total market index over the long term, albeit with a higher level of risk. A common mistake investors make is taking the wrong risks. For example, they fall for the notion that commodities such as gold and silver, oil, beef, or grains provide a hedge against inflation and a low correlation to equities. The evidence suggests they offer neither. The golden rule with risk exposure is to stay diversified. There's nothing you can do about market risk. It's a risk you need to take. But by diversifying across different asset classes, you can substantially reduce the risk of being too heavily concentrated in particular assets, countries, industries, or sectors of the economy. It also pays to diversify across time by holding your portfolio for as long as possible. Again, market risk is inescapable, but you should put it in perspective. Think of your portfolio as an investment in global capitalism. Yes, asset values are bound to fall as well as rise, but unless you honestly believe that Capitalism Inc. will go out of business, it makes sense to stay invested. So the optimal strategy is to invest in a portfolio that directly corresponds to your particular risk capacity, capturing every available increment of risk exposure. There's a right amount of risk for every investor. Armed with the information in Mark Hebner's book, Index Funds, the 12-step recovery program for active investors, you may be tempted to manage your investments on your own. But it might not be a good idea. Why? The main reason is you're only human. All investors are prone to emotional decision-making, especially when markets are volatile. Having an advisor to keep you calm and rational is extremely valuable. Also, do you have the time and expertise to do it yourself? The retirement system can be complex, and many investors have different types of accounts. These can include taxable accounts, traditional IRAs, and Roth IRAs. A good advisor can construct one portfolio that includes multiple funds divided among these different account types. The purpose is to maximize after-tax returns. An advisor can also rebalance your portfolio to adjust your current asset allocation back to the target allocation. Rebalancing ensures a consistent level of risk exposure and a smoother path towards your investment goals. Then there's tax loss harvesting. This entails realizing losses with a view to saving on capital gains taxes in the future. Another vital role an advisor plays is helping to ensure that you don't run out of money in later life. This chart shows the results of a portfolio simulation for someone retiring at 67. The green and gold bars represent the probability of the portfolio surviving over time. Running these simulations each year can help to keep you on course. One last thing. What you need is a financial advisor, not a broker. Specifically, you need a fiduciary advisor. The word fiduciary originates from the Latin word fiduciarius, which means holding in trust. In the investment industry, the fiduciary is obligated to act solely in the best interest of the client. Thank you for watching, and if you haven't already done so, do read Mark Hebner's book. We wish you a peaceful and profitable investment experience.